Well, good morning and welcome to the Solaris webinar on one of the best long-short investment opportunities following the recent Australian companies reporting season. My name's Mark Cormack and I'm a director with Pinnacle Investment. Pinnacle works alongside Solaris to distribute their investment management capabilities to the Australian financial advisory marketplace. And today I'm delighted to be joined by the Solaris long-short investment team of Damien Coyne and Gus Roberts. Just in terms of background, Solaris are an Australian equity fund management boutique who've delivered outperformance over the ASX 200 in 16 out of 19 years. And like all the boutiques within the Pinnacle suite, the Solaris team own the majority of equity within their fund management business. But equally important is that the Solaris team have had a stable investment team, and the core of that investment team has been working together for well over a decade. The Solaris team adopt a style-neutral approach to investing in Australian equities, meaning they're not going to be held hostage to a growth or value style, and it's meant that they've been able to outperform and deliver some outstanding investment results in all different types of market conditions. In terms of performance, the Solaris Long Short Fund has delivered over 6% per annum outperformance over the ASX 200 since its inception. So in terms of investment pedigree, Solaris have got one of the highest standards, and the team has also got positive research recommendations from all the major research houses here in Australia, including Lonsec, Zenith and Morningstar. And that's a really great endorsement and recognition of that team's consistent investment performance. And specifically to the Solaris Long Short Fund, the team has been crowned Fund Manager of the Year with both Lonsec and Zenith over the past 12 months as the best long short manager here in Australian equities. Enough from me. Before we start today's presentation, all listeners have the opportunity to ask questions, and that can be done by clicking the questions tab on your screen. So without further ado, I'll hand you over to the Solaris Long Short team of Damien Coyne and Gus Roberts for today's presentation.
Great, thank you, Mark. Just before we get into the details of today's presentation, I might just provide a bit more detail about us. So we are a style-neutral manager, and we pick stocks using bottom-up fundamental analysis. As you say, we're an experienced team who have been investing together for well over a decade. We are the majority owners of our business, and the entire Solaris team are material investors in our own funds. We have 7 empowered analysts who are the experts for the stocks within their allocated sectors, and this is where we are a little bit different to our peers. So we think an analyst rather than a single PM is best placed to weigh up an investment as they are the most familiar with the stocks. This approach has served us really well over the years, delivering a very diversified portfolio driven by stock selection, and it helps us avoid the top-down risks which can inadvertently dictate portfolio returns. This approach to portfolio management has consistently produced alpha in 16 of the last 19 years, and we're proud to say that our flagship core fund is ranked in the top quartile across all time periods. On to slide 4, this chart highlights the objective of our long short fund quite well. So it is a true extension fund. It leverages off our successful long only core fund. So it utilises all this IP, the same investment team as well as the same investment process. And as our previous slide detailed, our core fund has a long history of consistently delivering alpha year in, year out. But with the long short fund, we can now amplify these consistent returns through shorting and monetizing our negative views on stocks. Shorting then also provides the low risk capital, which we can use to reinvest into our preferred high conviction long ideas. So essentially grossing up the position sizes, which further adds alpha for our investors. So in our 130-30 fund, we seek to offer higher potential returns than a standard long only product, and that is across all market conditions. So with that, I'll now pass over to Gus.
Thanks, Damien. And moving on to the next slide, certainly it was a bit of a sigh of relief now the reporting season is over. But if I could sum it up in one word, it can probably be best described as unimpressive. But it certainly wasn't uneventful. So it was a really volatile results season. It did coincide with a plethora of geopolitical issues, and this was enough to break the market's strong previous run of 7 consecutive positive months, and the ASX 200 finished the month down 2.4%. Overall, financial year 19 earnings were weak, and in fact one of the worst in terms of EPS revisions since the GFC. Earnings were cut by 3% in August, we saw double the number of misses than beats, with around 40% of companies seeing financial year 19 earnings cut. Given we also witnessed many companies issuing profit warnings in the lead up, it is clear that large parts of corporate Australia are doing it pretty tough. Overall, however, stocks actually re-rated, and there was a clear trend of rewarding companies where management noted any green shoots or that were investing for the future. Elsewhere, companies that proved some of the doubters wrong include James Hardie and TWE, and there was a real clear gap between the quality top end of the market and the rest of the space. It is pretty clear that not everyone is suffering equally, and defensive stocks, as you can see in that bottom right-hand chart, reported better earnings results and outperformed as a result. So food and staples, utilities, healthcare and REITs also all doing pretty well. What else? The rise of high PE stocks continued unabated, so the momentum trade is alive and well. And on the flip side, some of the largest performance disappointments came from some of the laggards and cheaply priced stocks that are proving, that their value for a reason. Think the likes of AMP, Blackmores and Pact Group. So aside from this, there was broad-based weakness across most of the other sectors. In domestic cyclicals, there was a bit of a glimmer of hope that the consumer might be picking up, with the likes of JB Hi-Fi, Supercheap and even Myer yesterday beating expectations. However, it's certainly not clear-cut, with GPT, Scentre Group and Stockland all expressed concern about a challenging retail environment. This also was set against a backdrop of some pessimism coming from the construction sector and disappointments from Adelaide, Brighton and Boral. The one final observation is that share price volatility was extreme, and this is becoming a bit of a prominent feature over the last few years.
So on to slide 6. As an active manager, we actually don't mind a bit of volatility, and it's one way to take advantage of a spike in volatility is via the use of outright shorts, especially throughout reporting season. So with our outright shorts, we typically target companies that we believe have some earnings risk and are overvalued, or to be framed another way, we like to target stocks that we think are not priced for any sort of disappointment. The outright shorts typically need a catalyst, so for us, February and August reporting months are pretty important events. So who were the companies masquerading with strong share prices and flat to negative earnings growth? Well, the most notable and high profile this reporting season was Brambles, Aurora and Incitec Pivot. So Brambles reported a 5% EBIT miss driven by lower margins, which is kind of at odds with the rhetoric coming from management about recouping some of the input cost pressures. Financial year 20 outlook was also downgraded. So management now think inflation will remain a headwind and any automation benefits are not expected for another few years. Management also cited plenty of macro headwinds, so talking Brexit, a slowdown in the EU, impact from US-China trade relations, etc. But essentially this wasn't a good result and expectations leading into it were very high. Brambles trades on a locked-in multiple above 20 times, which we think seems unjustified for the flat to negative earnings growth they have delivered for the last 3 to 4 years. Aurora missed consensus by around 3%, which sounds like a small number, but when you operate in a very low margin, low growth industry, every basis point counts. The disappointment here came from their North America division, plus some of the outlook comments, which curiously no longer included any statement about earnings growth at all. So prior to the result, consensus were looking for around 8% growth year on year, but it's a tough industry, so we wouldn't be surprised if earnings actually go backwards in financial year 20. So on 16 times, we think Aurora looks a bit like a value trap. And then finally, Incitec Pivot, they delivered a massive profit warning. So management provided new guidance that was 25% below their previous downgraded range to now be down circa 50% on PCP. Management are blaming plenty of one-offs such as lower commodity prices, drought, even higher gas costs, but one really has to question their lower ammonia production. As a bit of a teaser, management have flagged a strategic review of their FERT division, or their fertilizer division rather, which is a little confusing to us, as previously management indicated they'd likely hold on to these assets with a view to exit at a better point in the cycle. So really, for better or worse, we think this division will continue to weigh on earnings, and we think it's a little bit too early to be buying Sec Pivot yet.
Now, if we move on to page 7, it's not all doom and gloom. On the other side of the ledger, James Hardie is a name that has prevailed against some sluggish macro concerns and is one of the few standout buys for us this reporting season. James Hardie reported a very solid first quarter. It was about 5% ahead of consensus. The US was the main driver of the beat in both volumes and margins. So volumes actually increased 4% for the period, which is a very strong number given detached housing starts actually declined 6%, and their main competitor, Louisiana Pacific, reported 0 growth. So they're gaining share essentially. EBIT margins increased to just above 25%, and this was helped by some early gains from their cost out program, and we think these margins are now sustainable for the remainder of the year as both input costs and cost outs offer strong tailwinds. Looking forward, we believe management guidance to be conservative. Their guidance assumes slightly higher raw material costs compared to pulp prices, which are already down about 6% on average. James Hardie is clearly outperforming its competitors, and their transformation strategy is working. After an enormous overreaction, mainly around some manufacturing issues and management change, we are now excited with the outlook for this stock. James Hardie has recovered from the lows, but it still only trades on a market multiple, which is a long way below its historic 50% premium, which it has commanded over the last decade. As you can see, that dotted red line, the upgrade cycle looks set to continue. We think the medium to longer term investment thesis remains strong.
And on to slide 8. So Altium is another stock that we really like, and this result gave us continued confidence in our long investment thesis here. So over the last 5 years, Altium have delivered 20% compound revenue growth and 35% compound EBITDA growth, and we think that this growth can continue. So not only are Altium confident that they can surpass their 2020 revenue target of $200 million, but management remain committed to the achievement of around 100,000 subscribers before 2025. And in fact, Altium is anticipating reaching its halfway mark of 50,000 subs by as early as next year. And as such, they have reiterated their aspirational revenue goal of $500 million in 2025. We think Altium are at a tipping point with their future growth initiatives. They clearly have a very solid management team, fantastic cash flow, strong balance sheet, strong organic growth, and are clearly winning share in a growing industry. So these are all very nice characteristics to have. But there is one small chink in the armour, and that's the valuation. And Altium trades on around 55 times today. So everyone wants to own a high performance, high growth stock, and quite frankly, in today's market, they don't come cheaply. So how do we manage this short-term valuation risk if we like the long-term outlook of Altium and want to remain long-term holders? Well, their answer is by shorting other high-growth stocks that we think have more valuation risk and we don't have the same degree of confidence in.
Moving on to page 9, as you can see, that yellow line there, the ASX 200 has delivered a pretty impressive 40% return over the last 4 years or so, but up against the mighty US FANGs, so Facebook, Apple, Amazon, Netflix and Google, that performance has been dwarfed. They're up close to 300%. Now, not to be outdone by the Yanks, we've adopted our own acronym, WAAAX, composed of WiseTech, Altium, Afterpay, Appen and Xero. As you can see there, these businesses have seen eye-watering returns. It's not really until you compare the performances you sort of really get some real perspective there. They're up a phenomenal 21 times. It's pretty easy to get scared on the valuations here, especially given that Australian high-growth stocks are the most expensive in the world, and by some margin. You've heard the thesis there from Damien on Altium, and while it's expensive at 55 times earnings, at least it is generating earnings. Some of these other stocks don't have earnings at all or a sustainable competitive advantage. Others are acquiring their growth. This sort of behaviour is irrational, but simply just too scary to blindly short on their own. We certainly don't know when it's going to end. You could have argued a similar case a year ago, 6 months ago, even a month ago, and you would have been annihilated on this trade. So we think a much smarter technique is to pair up and short against our preferred WAAAX, Altium. So what is a pairs trade? Look, very simply, it's a long and a short. They're usually in the same industry, they're usually homogenous, and they've become mispriced relative to one another. So it allows you to eliminate the common top-down macro risk, like the direction of the NASDAQ, which is always hard to predict. So the stocks in this pairs trade, they tend to move together in a risk-on environment. However, if we do get a shake-up, we believe the results will vary significantly. So we think this trade will make good money in a bull market or a bear market. It removes the top-down market risk and therefore makes it a really good pairs trade.
So just to wrap up then on slide 10. So we think overall the market is looking expensive and the corporate environment looks pretty vulnerable. The underlying trend of soft earnings momentum is expected to continue, and now we actually think there's some downside risk to those financial year 20 numbers that we've highlighted there, which is not really your ideal scenario at these current valuation levels. But this is obviously offset against a backdrop where global central banks are loosening. We have a weakening Aussie dollar, and the investment community is pretty thirsty for any growth at any price and investment yield. So we often say we're better at picking stocks than stock markets. So despite the risks, we remain fully invested in our 130/30 fund, with the overwhelming majority of our tracking area coming from stock specifics. So we still firmly believe that there are some good companies that are reasonable value with good growth prospects and solid balance sheets. They're still out there, and we think they will always endure regardless of market conditions. And then any heightened volatility really only adds to the opportunity for us to make alpha for our investors. So we think that the fund is pretty well positioned to continue outperforming through any market condition.
And then just moving on to page 11, we'll leave you with our performance slide. Thanks very much for your time. As you can see, down the bottom there is our rolling 12-month breakdown of our performance, split between our underlying core fund and the three shorting buckets. I'll now hand you back to Mark, and we're happy to take any questions.
Fantastic. Look, thanks, gentlemen, and a very timely update. Always great to hear your views on the market and how you position the portfolios, especially following an important time like reporting season. Look, just a reminder, all attendees do have the opportunity to ask questions via the internet, and this can be done by clicking that questions tab you can hopefully see on your screen. Look, while we give you guys some time to submit some questions, I'll just touch on just a bit of advisor feedback that we're getting just in respect to how investors, advisors are looking at implementing Solaris long short in portfolios. And I suppose one of the first points is that we have seen some underwhelming performance in long short strategies from some of our competitors. I've also seen some fund closures with the likes of Tribeca and long short managers in the market. Some of them are at or managing in excess of close to their capacity, or some managing in excess of $1 billion. So with that, some of the differentiating factors that advisors like on Solaris long short are the fact that you have got comfort in a stable team, a team that's got an investment process that has delivered consistent performance. As I mentioned, 16 out of 19 years, we've been able to deliver performance in all market conditions. In terms of access, a strategy that is quite differentiated in the fact that they do use a very different approach to shorting by using those outright shorts, the funding and the pairs trades. And finally, Solaris team do have a runway of capacity. They're going to manage up to $750 million, but this ensures that the fund is nimble enough to take advantage of both long and short opportunities in the market. So we have had a number of questions come in. I'll kick off, guys, a bit more of a macro question here. Thinking about all the headlines, the risks with Brexit, Trump, trade wars, etc. How do you expect the portfolio to perform if there was some form of sharp sell-off?
Good question, and it's one that probably plays on our mind more than it really should. But I think essentially we try to ensure that the risk in this fund is really generated from bottom-up stock decisions rather than allowing any macro event to dictate our risk and performance. So to this end, we can actually quantify how much the risk comes from factors, styles and stocks. So we know right now that around 80% of the total risk in the fund comes from stock specifics. So what that means is that this fund will live or die by the success of our stock calls rather than any top-down macro call. But in saying all of that, as we said before in the slide, we think fundamentally the market is starting to look a little bit expensive, some pockets more than others. So we have reduced some of our long weightings to some of these sectors. We continue to find plenty of opportunities from the short side in some of those expensive sectors. But again, we don't want to just focus on just price. You need to focus on quality as well. So we have found a lot of opportunities in the cheap, low quality space as well to short. And this sort of diversification should really offer some protection in a falling market because people will tend to take profits in the expensive stocks and the low quality stocks you'd think would underperform even more.
Yep. And I think our beta is modestly lower than the market at the moment. So on face value, you think we'd probably be pretty well positioned for a pullback.
Great. Okay, guys. Look, following some of your comments, do you think we're headed for a recession, and how are you positioned in domestic cyclicals, both on the long and the short side?
Yeah, I guess further on to what Damien's saying, it's I guess firstly we don't know, and we're certainly not the experts in picking the macro. The Australian economy is doing it tough. I think we sort of highlighted that. And in terms of positioning, we are underweight the domestic cyclicals. However, are aware that this space is heavily shorted. So if you do want to try and short any of these stocks, you've got to be really selective. There's probably a couple of opportunities out there. One is Star, which is a bit of a Star Casinos. It is a turnaround story. At their result, they highlighted improved domestic trading. They're executing really well on their cost out program. And overall, it's a cheap multiple and solid dividend yield. And the other one is car sales. They also had a solid result. They're on attractive multiple, especially against some of their peers, the likes of SEEK and REA, and they've got really good growth prospects ahead. And just to reiterate, we're sort of not short any of the retailers. We just think it as too scary, too risky.
Excellent. Okay. Have you guys made any wholesale changes to the portfolio resulting from some of these comments you made in reporting season?
Not really, no. Well, we certainly haven't from the long side. We have increased or added to some of our long positions where our conviction for the next 12 months has also increased. So most of the turnover has really come from the shorts. So with the outright shorts, we're pretty quick to take profits for better or worse as the events kind of happened. But what we'll do now that the dust has settled is sort of take stock of our universe and slowly rotate back into some of those funding shorts where the results weren't necessarily the train wrecks, but where we expect these names to sort of market perform at best over the next 12 months.
Cool. Okay. Specifically looking at shorting, a question here on short squeezes. There seems to be a lot of interest in them over the last month looking at reporting season. Any comments there?
Can I take this one? Yeah, there were some huge moves, and you're right, positioning is a huge driver of stock moves. And through reporting season, we spend a heap of time dissecting the results themselves, but also spend a lot of time understanding where the position or where the market is positioned, and this can be sort of equally important for stock direction. At Solaris, we've got a pretty strong risk management culture. It's sort of embedded in our process. And we also specifically run a risk management overlay on all shorts, and this is based on things like borrower availability, the level of recall risk, the level of the short interest, and also liquidity. And position sizes are risk adjusted based on these factors, and in some instances, where we deem them to be too crowded from a shorting sense, we don't take a position at all and deem it too risky. A short squeeze, as you guys would know, is a long short manager's worst nightmare, and this approach has sort of served us pretty well through reporting season and helped us avoid some of those really crowded sectors like retail, JB Hi-Fi, Balamese, Myer, some of those stocks that are just too scary from a shorting sense.
Okay, guys. We had a couple of questions come in more around the iron ore stocks, specifically a couple of people mentioned Rio and Fortescue. Any views on those at the current prices?
Specific to Rio, we have actually just topped that position back up after trimming some into that latest iron ore run. So we have actually added back to Rio in the last couple of weeks. Fortescue, we find it's a bit too hard. It's a bit too single commodity focused. Yeah. So it's almost like you're taking a bit more of a punt on the iron ore price, whereas Rio is a little bit more diversified. But yes, we like Rio back at these levels.
And both are generating heaps of cash at current iron ore prices, and both expect probably capital management from both Rio, Fortescue and BHP in the future.
Yeah.
Excellent. Okay, and there's been another question just in relation to funds under management and capacity, so I might answer that one. So currently the guys are managing around about $350 million in the long-short strategy. So there is a runway of capacity there. You know, as I mentioned in my introduction, the team are going to manage $750 million, so it's nimble enough to move around the market. So you've got $400 million of capacity, which is a decent runway of running this strategy out into the market, so it won't be closing anytime soon. Look, that's all the questions we do have for today. We will wrap things up on the webinar. Just as a reminder, the Solaris funds are currently available for direct investment, and they are available on all the major wrap platforms. We have got positive ratings from the likes of Morningstar, Lonsec, Zenith, and the Solaris Long Short team has been awarded Fund Manager of the Year for Best Long Short Investment with the likes of Lonsec and Zenith. We will be making the webinar available on the Solaris Investment website later today, which is www.solariswealth.com.au. I'd like to thank you for your time today, your participation, the questions. If you do have any further inquiries, please do not hesitate to contact the Pinnacle Distribution team. Thank you for your time and have a great day.